of your time, but thanks again for joining us tonight on this webinar. The title of it is the mid-year market outlook, but of course, as in our previous webinars, we like to talk about the three things that we do best. So a financial psychology topic, financial planning topic, and then the market and investment management. So we'll have Dr. Brad talk about the financial psychology side of gifting. Then we'll have Nick Morata talk about the financial planning side of gifting. And then Bora will talk about the market and the mid-year outlook. So before we start, of course, always the fun part, just a quick disclosure. The information contained is intended to be used for educational purposes only and is not exhaustive. Diversification and or any strategy that may be discussed does not guarantee against investment losses, but are intended to help manage risk and return. If applicable, historical discussions and opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believed to be reliable. And lastly, the content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional specific for information specific to your individual situation. We also have a copy of our Form ADV. If you would like, upon request, just send us an email or give us a call, and we're happy to share that with you guys. But having said that, we can go ahead and get started with the fun part of the night. So again, set mid-year outlook, and we'll have Brad, Bora, and Nick. And we can start with Dr. Brad Klontz talking about financial health that doesn't hurt. So I'll turn it over to you, Brad.
Yeah, thanks, Federico. Glad to have you all here. I understand Biden is about to address the United States, so please stay with us, though. This will be more interesting, although that'll be fabulous too, I'm sure. But we wanted to talk a little bit about a topic that comes up quite frequently in work with our clients, and that is financial health that doesn't hurt. And quite often, those of us who have means or growing means are looking for ways, well, parents in general, and if you're a grandparent too, like how can I help my children and grandchildren benefit from the resources either I've inherited or I've been able to acquire myself? How can I help them without hurting them? It's a very complex topic that really does depend on so many factors, including the personality of your children, their previous behaviors around money and motivation. But there's some red flags to look out for and some ways that financial help can actually hurt. And that's something we, of course, are wanting to avoid. So when financial help hurts, what is it we're seeing, and why should we be concerned about this? Well, in the research that I've done at my university, we have identified a couple different syndromes, I guess you would call it. And so when financial help starts to hurt, we look at that as something that we call financial enabling. So we're sort of enabling things in a bad way, in a harmful way. And how do we know it's harmful? Well, that's when we start to notice signs of financial dependence. And this is what we are ultimately trying to avoid. These are the red flags at which we would then say, maybe the financial help I'm offering and the things I'm trying to do with money aren't getting the results that I'm really hoping for. And so financial dependence is a syndrome that we've identified, and it seems to be quite common, frankly, in a couple situations. It's a real similar symptom pattern or behavioral pattern for people who come from, multi-generational trust funds. It's a similar pattern to people who come from multi-generational welfare support family systems. It's really interesting because those are arguably and stereotypically really opposite sides of the spectrum in terms of net worth. So people are really struggling. They have very low net worth. People have really high net worth. But the syndrome that we've observed is that people who have money coming in without strings attached report, and this is their self-report, that they lack creativity, they lack a drive, they lack a passion, and they also have feelings of resentment towards the source of the income, which is an interesting concept. And so on the trust fund side, this is where people can have some resentment towards their parents or their grandparents, perhaps the trustees, around the rules of how those resources can be used. And then on the other side, you'll find people who are getting money from government or other agency supports, and they have a tendency to resent sort of the rules or whatever restrictions are being put on them regarding that. Studies have found that financial dependence, that females are at higher risk, and especially females raised in wealthier families seem to be at the highest risk of developing this syndrome. And I do believe it's somewhere between 50% and 2/3 of women in abusive relationships report that they end up returning to their abuser because of their financial dependence and their lack of financial independence. Um, so that's ultimately what we're trying to avoid. And I thought I would share with you 5 recommendations for when we're looking at that financial help and perhaps whether or not it's hurting and things to consider. And hopefully you'll find this interesting. So the first is recognizing that financial help can hurt. It can create that financial dependence, and so we want to be careful of that. I also, I also think that we make a mistake when we look at somebody who is perhaps lacking motivation or a drive or a passion. When we look at them and we make assumptions about their character, when we think, oh, they're lazy or whatever that is, because you could take any child, and by using money as a reinforcer, you could create that pattern of financial dependence, any child, because we all have a natural tendency to seek pleasure and avoid pain. And so that's one thing to consider, is that if you're seeing some of that lack of drive, lack of passion, lack of stick-to-itiveness in terms of jobs or whatever it is, start to be thinking about how is this money being used as a reinforcer. So a reinforcer is anything that increases the chances of a behavior happening. So, for example, for my children, when I want to get them to do what they're supposed to do, I incentivize them with iPad. Actually, it's worse than that. I threaten to take away their iPad. That gets me the most bang for my buck, in terms of trying to modify their behavior to get them to stop fighting with each other or whatever it is. Money is an incredibly powerful tool, like that iPad time is for my kids. When you work hard for money, it reinforces working hard. So, for example, if I could get all my bills paid starting out as a child without lifting a finger, without having to struggle at work, because even if you love your job, there's going to be a day you don't want to go. If I don't have to go, it makes sense that I would then develop an entire approach to work where I don't want to work. Why would I work? Work can be hard. It can be challenging. It can be difficult. And if I don't have to do it, why would I do it? I'm not crazy. If people are asking for money and they get it just by asking, it increases the chances that they're going to ask. Of course it does. It reinforces that behavior. If I'm getting money for not working, I'm not going to be incentivized to work at all. This is human nature. And so that's the first thing I would say, that when you find somebody who's in a behavior pattern that from the outside you might look at as like, what's wrong with them? They're being lazy, this or that or the other. I don't see it as a characterological thing at all. I think it's the natural result of how money is being a reinforcer in their lives. So it can be hard to recognize, especially when we're doing it. Like my biggest blind spot is with my children. It's much easier for me to see what's happening for other people's children. But when it comes to my children, it's harder for me to see, is that helping? Is it hurting? So the first thing is recognizing that it can hurt. The second thing is understanding why it hurts. And I'm going to talk about a couple of the ways that it hurts. We like to think that the more choices we have, the better things are. It's a sense of freedom, right? Of course, we want choices. We want opportunities for ourselves and for our kids. But when you have too many choices, it leads to immobilization. And so, for example, you will find somebody who, let's say that we tell them they can go to 20 different universities. They're more likely to be immobile in that situation than if you had them pick between 2 universities, just as an example. And so if you have money coming into you that isn't into your life that isn't attached to any work type behaviors, and you have an unlimited sense of choices, it actually can backfire, and people can actually get depressed in that scenario, especially if you're less psychologically mature. Fewer options are actually better to get you to motivate you to take action. And work has sort of the right amount of suffering. There's at least suffering involved in work. which builds that sense of character. So too many options, not necessarily good. And our default is the better. So just to be thinking about that. People stay stuck in them too many options. The next thing to think about is free time. Um, Free time sounds great, but too much free time is actually bad for your health. Now, this is really tough to believe because, of course, we're looking forward to the weekends. Of course, we are. I'm in Hawaii right now, kind of a vacation. I'm here working, but also a bit of a vacation. It's great. It's great. Weekends, vacations are great. Well, what's so fascinating is that psychologists have done this study many, many times where you would give somebody, now I'm sure it's on a cell phone app, but you give somebody this little device that they would have them check in and rate how they're feeling every hour, 2 hours, or 3 hours. And contrary to what we believe, what these researchers have found is that people are actually happier at work than they are on the weekends and on vacation. Now, so wrap your head around that. We all believe we're happier on the weekends and on vacation. Of course we are, but people actually are less happy when you don't ask them how they feel about their vacation. You just ask them to straight up rate how they're feeling moment to moment. And one of the reasons for that is that people tend to have more unstructured free time. And it's that unstructured free time that leads to psychological suffering. And this is where I talked about being psychologically mature. It matters. And people who are actually transitioning from a work life to retirement life can also struggle with this concept of free time. There's something about work. There's built-in social interactions. You have goals, you have challenges. You're immersed quite often in some type of activity. In psychology, we call it a flow state. You're in a flow state. You're kind of forgetting about yourself, forgetting about your worries, because you need to focus on accomplishing that task. Well, if you don't have a lot of structured time on the weekends, like we do on the weekends or vacations, people have a tendency to get more depressed. So they have a tendency to sit and think about, some of the existential realities of life. Not to get too depressing, but the existentialists are really depressing. But what's the meaning in life? And I'm alone and I'm isolated, especially if I had that built-in reinforcement in work. And so that free time can actually backfire and make people miserable. We think it's going to make them happier. And there's nothing wrong with giving your children a year to travel abroad. As a matter of fact, I wish my parents had done that for me, or a year to write a novel, etc. But you really have to pay attention to how that child is responding to that and what's happening for them, because it can backfire and it can make transitioning to a real job difficult. So keeping that in mind, that too many choices aren't great for you and too much free time, not great for you. So let's say that you have found yourself in a situation, or you have friends who have found themselves in this situation where somebody's has become financially dependent. So they're getting money, and you're noticing that they're not building up that other side of their lives that you would like to see built, of a good work ethic, people who are, putting their time into something that matters. So they have that built-in sense of purpose. They have some passion. They have a drive. That's really what we're wanting for our kids, whatever it is that they're pursuing. And you're noticing that's not happening. Well, quite often people have already warned that child multiple times, or the grandkids. These can be adults too, obviously, adult children, and they've been warned. The money's going to stop coming unless you get a job, etc. But I'm just telling you right now, it's human nature to not take action if you've been warned multiple times and nothing really has happened. And so that's where we can get into crying wolf. We've accidentally found ourselves where we keep making threats, crying wolf, and it's not leading to any sort of action. So there's a process. We won't spend too much time with it, but what we have found to work best is setting a time at which that support will end, brainstorming other ideas of support. So perhaps I'm not giving you cash, monthly cash, because I see it's actually hurting you. It's not helping you. And so instead of that, I'm going to pay some money to somebody to do some career counseling with you, or something like that. And then it also can help to develop a script and get some help developing a script around when that time's going to end, perhaps even apologizing for your part in enabling them, and offering these other types of support. And then what's really, really important is developing a support system in place, because it's going to be really tough for you to actually stop stop having somebody you really love receive those resources, even if you know it's not great for them, because you're hoping it will be. And so lastly, if you have found yourself in the situation of trying to figure out how can I give and share the resources and the abundance that I have in my life and we have it within our family system with my kids without hurting them, how can I make sure it's enhancing their lives and it's giving them opportunities and they're capitalizing on those opportunities versus psychologically crippling them in terms of their drive and their passion and their creativity, et cetera. Ask for help. And that's why we're here. We've your advisor here at YMW Advisors, we've helped a lot of people navigate this, and we could be a sounding board for you to help you come up with ideas and strategies. So don't be afraid to reach out to us to run some ideas by us in this regard. With that, I'll turn it over to you, Nick.
Thanks, Brad. Let's see if I got the screen. Okay, a lot of good information there. That's, things you want to be cognizant of when you're giving to individuals. Of course, there's a lot of positives to giving to individuals if it's in support of goals and help them with their work ethics and being appreciative of it. And so I'm talking more about the logistics of giving. This I get a common question about, and there's a common misconception and confusion around gifts and associated tax and annual tax exclusion. What is a gift? So I thought it would be good to talk about some things that are gifts, how it all works out in terms of gift tax overall, and just to give you a basis of making those gifts if you decide to do so in the future to individuals. So simply, what is considered a gift? You make a gift if you give property, including money. It could be income from property, and you don't get the same amount without expecting to receive something of at least equal value in return. Also, if you sell something that is less than its full market value, or give a reduced interest rate loan or an interest-free loan, that is all considered a gift. And you may say to yourself, well, why does the IRS need to know what I'm giving to my family? They can just butt out. Well, that is true until the point you get above what is called the annual gift tax exclusion. And so the annual gift tax exclusion is an annual exclusion amount is how much a person can transfer to another person without paying a gift tax. So this mostly applies to people who have accumulated assets, right? Then they're looking to give and help out maybe a family member or individual because they've done well, overall. And you have a choice to give, while you're alive, and you have a choice to maybe include someone in an estate plan upon your passing if you choose to do so. But there are more, there's a period of time that may be more impactful and may be more helpful in terms of when to give in people's lives overall. So I borrowed this slide from Kitsy's, and it really just says, for those interested in helping family or children, gifts received between the age 20 and 35 will be far more impactful than gifts at 35 plus. And there's a simple reason to that. When you're less than 35 years old, you haven't really accumulated a lot of wealth, but yet you have to do some pretty powerful financial things, such as maybe, in your young 20s, you're going to school and college is very expensive, or you're buying your first home, or you're starting a family. These are expensive things that have to be done without having the backing of a bunch of assets like you generally do in retirement, starting a business. So, you could make the case that $50,000, for example, at age 25, for a down payment on a house may be more impactful than inheriting $500,000 at age 65, because hopefully at age 65 you've accumulated your own assets and prepared for retirement. So it may not make as big of meaningful impact in kind of helping them move forward with their life and their family and so forth. So assuming most retirees were between ages 20 and 40 when they had children, your most impactful giving ages are usually, for the giftors, between ages 40 and 75. So I'm going to focus on the gift tax annual exclusion here, which is this $18,000 figure. So if you give a gift to somebody, an individual, and it is less than $18,000, you do not have to report that to anyone. You do not have to fill out anything on your taxes. You do not have to pay any kind of gift tax. If you are married, you can give an unlimited gift to your spouse. Vice versa, individual accounts can go back and forth between spouses as long as they are US citizens. If you are married and want to give a gift to your kid, you can double that up essentially. And one 18,000 piece would be from the husband and one 18,000 piece would be from the wife. Now you need to make sure if you do gift in that way that they are documented properly and keep the record. So for example, if you're writing a check, I wouldn't write a $36,000 check. I would write an $18,000 check signed by the wife, an $18,000 check signed by the husband. And why is that important to keep records? Because all of this is kind of on the honor system unless you are audited. And then if you are audited, you have to show documentation of how things were transacted. You can double up at the end of the year, giving $18,000 gift on December 30th and then giving an $18,000 gift on January 2nd is completely okay. The annual gift tax exclusion basically resets itself every single year. And again, you don't have to report anything to the IRS or on your taxes. So here's an example. A retiree has 2 kids and has 3 grandkids. So they could give up to $90,000, which is this $18,000 times 5. Now the gift would have to be to each of those individual persons. You can't just give to the parent for the benefit of the grandkids. So in this group here where the one child has 2 grandkids, you're like, oh, well, I'll just give 18,000 times 3 to my kid for the benefit of the grandkids. That doesn't count. You actually have to give it to the individual to be under the annual gift tax exclusion. And this is an example, of course, giving a considerable gift, and giving a considerable gift may be appropriate based on your situation and based on a situation that you may want to be under your lifetime exemption, which I'm going to talk about next. So there is a lifetime exemption of 13.61 million per individual, which all that means is when you pass and your estate is worth under 13.6 million, there is no estate tax. If your estate is above 13.6 million, that amount is taxed at a rate of about 40%. So when you give a gift, essentially, and you give a gift above 18,000, let's say 118,000, that is when you need to file a gift tax return. And so you have 2 choices. You can file option A. You wouldn't pay any kind of tax on that 118,000, right? The first 18,000 is excluded. You would file a form called 709, but you'd have to then take $100,000 off of your lifetime exemption. So then when you die, if you die over 13.51 million instead of 13.61 million, then the amount above that is taxed. Now, if you're married, that lifetime exemption is doubled, so roughly 27 million. And this is set to go away at the end of 2025 if there is no extension of the Tax Cut and Jobs Act. If you gift property, the cost basis is transferred if you take it off your lifetime exemption. So if you paid $20 for a stock, it's worth $100. You give that stock to a family member. The gift amount is at the $100, but the person who's receiving it is receiving it at a cost basis of $20. So if they sell it, they are still responsible for the taxes. Now, option B of giving a gift above $18,000 is less used. That's where you keep your lifetime exemption in check, but you pay gift tax for that particular year. And if you pay gift tax on that particular year, which is a graduated scale between 18 and 40%, then the cost basis is adjusted when giving to someone else. So you can gift stock in lieu of cash. And again, the cost basis gets transferred if no gift tax is paid. And if the recipient sells the stock, it is determined by their status of income. And we've used this strategy with clients before, where if you look on the bottom here, there is a bracket basically that you can pay 0% capital gains when you sell a stock. And if you are married, filed jointly under 94,000 or single under $47,000 in income, and you sell a stock and the capital gain is incurred, and you're still below those levels, then you'll pay 0% taxes. Most of us are in this range right here, the 15% rate, and then high earners are in the 20% rate. So if your goal, for example, is to sell a stock that has significant exposure, an Apple, Microsoft, and Nvidia grows to a particular portion of your portfolio, and has a lot of appreciation with it, rather than selling it to reduce down your exposure, if you give it to maybe a younger member of your family or an earner someone who has less income and falls in this 0% rate, by giving that to them and then them selling it, they pay $0 taxes. So if you would sell it and cut down your exposure, you would pay 15% taxes. But if you give it to someone, it's the same value, and then no one in the family pays taxes. So essentially, it keeps more value in the family. Now, you can't do this on a significant basis unless you'll get above the annual gift exclusion of $18,000. But it is a strategy to kind of take off some of the gains of a portfolio and transferring it to younger generations that can benefit from the 0% tax rate. Now, the downside of that is if you own a stock and there's a capital gain embedded in it, when you pass away, that gain is gone. You get a step up in basis upon passing. So you do lose that on a long-term basis. Another reason why you may want to give stock away that may have really great future appreciation is if you are close to your estate tax exemption limit, which is the lifetime exemption of 13.6 million. You can set up kind of a gifting strategy, and by giving future appreciated gift or what you believe is a future appreciating gift, take it out of your estate and let the appreciation grow in someone else's estate that is not subject to that lifetime exemption. So there's a couple different exemptions here, and these are specific to gifts. So if you make a payment directly to a medical service provider, a doctor, a hospital, one of your family members or a loved one has a huge hospital bill, you can pay directly to that particular hospital or doctor, and there's no limit on how much you can pay, and you don't have to file gift tax return. Also, you can pay direct tuition for anybody, and that's not treated as a taxable gift. As well, a 529 plan, which is a college savings plan, can be front loaded. So you can basically get the money working for you in a quicker period of time by front loading the first 5 years. So you can do 5 years of gifting all at once. So a total of $90,000, or a spouse $180,000. But then you can't give anything to that individual for the next 5 years. But if you really want to front load a college savings plan and let time value of money work for you, the 529 may be a good option. You can give an unlimited amount to a political organization, and you can give an unlimited amount to charity. You are limited in terms of your tax deduction. We could do a whole webinar on charitable strategies and charitable givings. This is more about giving to individuals. So this is becoming more and more common in the current interest rate environment. We're in a higher interest rate environment. We're seeing parents buy houses for kids, or structuring a note receivable or a loan. This can be, instead of that, you give a loan as a gift. And that family loan can be flexible and mutually beneficial. If someone doesn't have enough money for a down payment, they can still get into a house, for example, and then the person providing them that money can get cash flow back to them with interest overall. It can also instill responsibility of managing that particular loan over a long period of time. You should structure this in a way that is legal in manner, with a signed written agreement, a stated interest rate, and a fixed schedule for repayment. You can't simply charge us any interest rate that you want to. The IRS has rules on this as well. There's an applicable federal rate for loans, and if you don't follow those applicable federal rates, you can be penalized for it, and it can be considered a gift. The rates are lower than the current interest rate, so it's still a discount versus going to like a bank per se. And then later on, you can forgive the loan. And if you forgive the loan and it's more than $18,000, that's considered a gift above $18,000. Or you can sell a property to someone at less than full market value. But if you sell it at less than full market value, greater than $18,000, then that is also considered a gift. The real pro of this is we're cutting out the middleman, right? If you're in the financial situation to help someone out, you're not involving a bank, right? All that interest that maybe a kid would pay over the course of time on their first home goes to the bank. But instead, if it's a family loan, it goes to the parent. And so all that interest saved stays in the family, and more than likely it comes back in inheritance at some point in time in the future. Now, the risk of this and the big downside of this, especially if you're hurting, not helping with a gift, is that if the loan is not repaid, or if they are not repaying it on a timely manner, it could cause a strain in the family dynamics. And so you have to weigh out, is that worth it overall, helping them financially, but potentially causing a strain in terms of paying that loan back. So there's a couple ways to gift specifically to children. One easy way is a custodial account. And a custodial account is an easy account to open. You can open up with one at Schwab. The assets are treated as owned by the child, so it's reported under the child's social security number. There are some tax advantages with it. That when unearned income is reported to a child, there is a kiddie tax. And basically, if it's under $2,500, so let's say dividends and interest under $2,500, it will likely be tax-free. If it's above that amount, it's going to start to be at the parent's tax rate. So this is not really meant for big gifts. It's meant for smaller gifts overall. But the downside of this is, well, there's a couple downsides, but the one is that you can't control the money. So when that minor, now adult, turns either 18 or 21 in the state of Florida, the UTMA Act, Uniform Transfer to Minors Act, is age 21. Legally, they can take the money. You have no control over it as the custodian. They can do what they want with the money. So you lose that. Now, if you're part of a bigger gifting strategy and it's a larger sum of money, that's when you would include trusts. And trusts are more costly to implement. You have to work with an estate attorney, but they're more complex, but it allows you to have greater control. So rather than them getting the money at age 21, you can have restrictions in terms of the age and the distribution and how much they can take out. If you trust someone to have the discretion over when that person is responsible to take out the money, you can give a trustee a discretion. If there's special needs, the trust can protect this principle of money for that individual without messing up their government benefits. If that young adult to a grown-up has issues with creditors, if we keep it in the trust, there's asset protection and other safeties there overall. So there's two different things you can do there. One is for smaller, I think, gifts, and one is for larger gifts. Now, one thing with the custodial account, another kind of con, is an asset that's owned by a student. If they are looking for financial aid, which is FAFSA, it is counted nearly 4 times as much as what a parent's asset would be. So if it was in a 529, assets are counted less on the financial aid application, which about 5% of parents' assets or 529 assets are counted towards expected family contribution for 529s, versus a custodial account, 20% of that asset is counted towards the expected family contribution. So it's not even weighting there. One of the best things that I've seen in terms of helping out a young adult is if maybe 16 to 20, their 20s or so, if they have, they're earning income, but they're not really saving that much. As long as they have earned income and aren't earning too much, they can make a contribution to a Roth IRA. Instead of them making the contribution, you can make the contribution into the Roth IRA. And the IRS doesn't care where the money comes from, as long as you just have the earned income. And it's going to be below the annual gift exclusion, so you don't have to report anything. And a Roth IRA, with the tax-free benefits of growth, there's also some flexibility in Roth IRAs for first-time home buyers and some other things. It's a great way to start out a young person's long-term savings. So I hope that kind of helps with the understanding of gift tax, when to file, gift tax returns, annual exclusions, and some different ideas. Bora, I'll let you take the hard part, which is the market outlook.
Thank you, Nick. I'm not sure if it's harder, but I hope I can keep folks out of sleep here. Let's see if I can take control. All right. One thing I want to add is that everything Nick said is correct, but it depends on the state you are in. Like in California, unfortunately, we do not have capital gains taxes. All income in California is income tax. All capital gains is income tax. So you might want to check your state tax laws. But otherwise, it was great. Apologies. Okay, so my presentation this evening will be about the second half 2024 global economic output. Outlook, excuse me. So the gist of this presentation is talking about global economy. It has been growing on a solid footing for the most part of 2023 and 2024, and it has been surprising to the upside. Aggregate measures of economic growth, as seen in this slide, like Purchasing Managers Index, which looks at purchasing plans of companies, it continued to move away from recessionary zone since last year, late 2023, and throughout this year. The area we circled shows quarterly increases every 3 months and has been a steady, balanced growth trend in purchasing managers' purchasing plans, which is a sign of economic activity. So in this bracket, in the blue line, is the All Country World Index global stocks. As you can see, when the economy does well, I think it's easy to say it bodes well for the global economy, global stocks, global equities. Two of the world's largest economies, US and China, have shown strong and steady growth this year, 2024. Other major players like the Eurozone, UK, and Japan, they have picked up, even Canada, this year after dealing with recessionary pressures of last year. The key point here is, if you want to remember one sentence from my presentation, we do expect this global economic expansion to remain steady for the second half of this year with low recession risk, likely even in the next year. Although due to cyclical nature of economic activity, we may see signs of weakness and slower growth. This, as we will see, may be countered with central banks' easing policies, as in rate cuts. Let's look at global economic expectations index, which has been rising since mid-2022. As seen in the lower bracket, colored in orange, the circle trend down may signal a peak in June of this year in expectations in the global economic outlook. But it still gives us this year and likely early next year in expansion territory. Again, June of this year may be the peak of our global economic output, but it still gives us the rest of this year and early next year as global expansion territory. Let's look at global recession probability model. So the circled area down bracket, the orange line, even though you see a peak, an increase in recession probability, it's still below our expectation of a recessionary zone. And again, we do see signs of slowing global economy. We do see signs of weakness, but it is far from recessionary zone, especially for this year and early next year. The same can be said about the Eurozone probability of a recession. It has been increasing since mid-2022, but lately has been on a sideways trend. Plus, we need to add the fact that the Eurozone has structural challenges such as low potential GDP growth, unfavorable demographic changes, and lower productivity. These have been the curse of the Eurozone, along with newly added political turmoil like we have seen in France. All right, moving on to everyone's favorite topic, inflation. The blue line here, OECD CPI, can be seen as global inflation, and the dotted orange line is global supply chain pressures. Pressure index moved up 6 months, meaning the global supply chain pressures index leads global inflation by 6 months. Leading indicator, lagging indicator. And as we see here, we circled in red, a sideline trend is forming in inflation, and somewhat the same can be said for supply chain pressures. The disinflation we observe in this chart, meaning inflation coming down, is due to the normalization of the pandemic-related pressures, massive disinflation in goods prices. But unfortunately, services inflation has been, here comes that famous word, sticky. With global economic expansion we have outlined, this growth has applied newly found pressure on products and service prices, and will likely continue. And as a result, the momentum in disinflation, inflation coming down, has slowed down. Now let's talk about global central bank policies. As seen here, the down bracket, 42% of central banks globally have been cutting interest rates. It is unusual that the Fed, which usually leads this pack, has been sitting on the sidelines of this trend. The orange line shows the increase in central banks that are easing. This raises the question, what will Fed do? When will Fed do that? And how that will affect us in the economy and the markets. So most likely, we will see rate cuts before the election. If not right after. There are 3 more Fed meetings this year, September, November, and December. If it doesn't happen in September, most likely in November or December, we'll get rate cuts. And here are some reasons why. Inflation has receded, as shown in previous charts. Employment is in better balance. Policy, this is rate policy, already restrictive, as seen in low loan demand and rising delinquencies. Rising delinquencies is one of the blood pressure areas of economic indicators. And the economy has slowed down in GDP growth, and US especially, globally as well. So these are obvious ones for us to guesstimate that the rate cuts may not be too far in the future, as we said, as I said, most likely in September. So what happens? Look at this chart, S&P 500. These are 4 averages of past rate cuts. Excuse me, I'm so used to saying rate increases for the last number of years. Rate cuts. What happens is there are average, the black line, all rate cuts. The blue line, slow rate cuts. The orange line, fast rate cuts, and the green line, the no rate cut cycles. So the dotted vertical line that we pointed, that's where things start. First rate cut in months prior and months post. Just look at the S&P 500 tending actually a lower, dipping down just before rate cuts, and after that almost all averages move up, except the no rate cut scenario, green scenario, kind of goes the other direction. But what we will most likely see is a slow cycle, and that is the best scenario when it comes to S&P 500 average trend afterwards. If you look at months post, the x-axis, all the way to 18 months out, it will be shocking to see if equities do well. This is true for all cycle average as well. It's just that it's better in the case of slow cycles, and that's what we think we're going to see. All right, last 2 charts. And this is how I will try to wrap it up. So if you add it all together, we see a slowing down economy, which will most likely be countered with rate cuts, and that bodes well for stocks and bonds too, by the way. Bonds do well because of their inverse relation with the prices of bonds and interest rates. But we may see some volatility, and it is worth noting. So the interesting thing about how markets move is if there's an extreme in the sentiment, optimistic or pessimistic, works both ways. An opposite direction trend seems to resume. Look at 2008, the vertical dotted line. The orange bracket shows a high in optimism, and it seems to be just before the start of a downtrend in 2008, when everyone is so pessimistic, as Warren Buffett puts it, when there's blood on the street. The below orange bracket shows extreme pessimism. Boom, that seems to show the start of an uptrend. There are other areas in this chart that will coincide to the same type of story. So look at the very right of this chart, really high optimism, and we are looking at the top in the market. So it wouldn't surprise anyone if we see volatility. This is a sentiment, crowd sentiment poll. July 16 is when we put this together, and a slightly different data point. This is traders, not crowd, but trading sentiment. As you see that there's already a dip, and this is a week after July 23rd, yesterday, dip in S&P 500, which is the top bracket, the blue line, and also orange bracket, the down bracket. You see the sentiment is going down. So this is actually a good sign. I know the last couple of days market has been coming down, and it has maybe raised some eyebrows. It is in line with extreme levels of sentiment and how market trends afterwards. To summarize and wrap it up, this does not change our outlook in the economy. We expect to see a growing economy this year and early next year. We expect to see Fed cutting rates towards the end of this year or next year, which bodes well for both stocks and bonds. Thanks for listening. Federico?
All right. Well, thank you, Bora, for the market outlook, and thank you, Brad, as well, for talking about the financial psychology aspect of gifting, and Nick for those strategies and the financial planning implications